Hey, it's Owen here with Owen Finance, your gateway to smarter investments, sharper financial insights, and also the ever evolving world of crypto and much more. Ready to level up your financial game? Let's dive in. Imagine walking into a market where you can pick up raw materials like gold, oil, or even coffee beans, and then trade them faster than you can say price fluctuation. That, in a nutshell, is what dealing with commodities is all about. Commodities are basic goods used in commerce that are more or less uniform in quality across producers. One barrel of crude oil is generally the same as any other barrel, no matter who pulls it out of the ground. This uniformity is what separates commodities from other assets, like a specific company's stock. When you buy shares of a tech company, you're essentially betting on the success, or spectacular failure, of that one firm. But when you buy a commodity, say wheat, you're speculating on broader factors like global demand for bread, climate conditions that affect harvests, and sometimes even trade policies that can shift on a politician's whim. Doesn't that sound like a fun party? Historically, commodities have been traded for thousands of years. Ancient civilizations bartered grains, metals, and spices long before smart, phone-addicted traders started yelling into their headsets. These commodities weren't just consumables or pretty trinkets, they also served as an early form of money. People were happy to accept cows or sacks of salt because they knew there would always be someone else willing to trade them for something else valuable. Over time, these local markets evolved into massive global exchanges. The principle stayed the same: commodities are foundational to societies. Gold has made empires wage wars. Spices brought explorers across unknown oceans. Oil turned desert nations into powerhouses. Even now, your morning coffee might come from beans that have been traded half a dozen times before reaching your cup. To make sense of the vast universe of commodities, it's often helpful to categorize them. First up are the industrial metals like copper, aluminum, and nickel. These are crucial for modern manufacturing, from wiring your house to building your smartphone. Next, there are precious metals like gold, silver, and platinum, loved by both jewelry enthusiasts and folks who wear tinfoil hats while preaching that the apocalypse is just around the corner. Then come the energy commodities: crude oil, natural gas, and coal, which basically fuel the global economy and occasionally ignite heated debates about climate change. Finally, there's the entire suite of agricultural commodities: wheat, corn, coffee, sugar, cocoa, essential not just for your favorite pastry, but also for certain commodity traders who need caffeine to make it through the day without screaming at the price charts. Trading commodities isn't like strolling through a grocery store and picking out apples for your pie. Sure, you can do that if you're feeling old school. You can physically own these goods. But nowadays, most commodity trading happens on exchanges like the Chicago Mercantile Exchange, CME, or the London Metal Exchange, LME, and it's all done electronically. You can buy and sell these raw materials with a few clicks, and you're not required to store 100 barrels of oil in your basement, although that would certainly help if you ever wanted to turn your house into the setting for a post-apocalyptic bunker fantasy. If you'd like to dip a toe into commodity investing without the complexities of futures or storing physical metals, you can also buy commodity-based ETFs, exchange-traded funds. These allow you to track the price movements of a given commodity or a basket of them without owning the stuff directly. One of the most common ways traders gain exposure to commodities is through futures contracts. A future is an agreement to buy or sell a specific quantity of a commodity at a predetermined price on a set future date. This is where things can get wild. People often think that only huge institutions or professional traders use futures, but that's not entirely true. Anyone can access these markets if they have a brokerage account that offers them. However, just because you can, doesn't always mean you should. Futures can magnify gains, but also magnify losses in a way that might make you contemplate a new career path, perhaps as a professional hamster trainer. Options and other derivatives also come into play here. They give you the right, but not the obligation, to buy or sell commodities at a certain price. These instruments can provide a way to hedge your risks if, say, you're a farmer worried about the price of wheat plummeting right before harvest. But they can also be used for speculation, which is a fancy way of saying legal gambling on price movements. All these ways to trade commodities ultimately hinge on factors that influence their prices. Supply and demand sit at the heart of it all. If a major oil producing country suddenly cuts production, oil prices can skyrocket, at least until someone else steps in or the global economy decides, you know what? Maybe we should switch to bicycles. Weather plays a massive role in agricultural commodities. If coffee crops in Brazil suffer from a drought or an unexpected frost, that daily latte you cherish might start costing an extra dollar. Geopolitics also worm their way in. Sanctions, tariffs, and even rumors of wars can send commodity prices into a tailspin. Suddenly, your safe bet on copper futures turns into a roller coaster ride because some politician halfway around the globe decided they needed more camera time. Economic cycles are another big one. During a boom, factories need more metals, energy, and raw materials. But when recession talk dominates the news, demand drops, prices can tumble, and your commodity play might turn into a money pit. Despite these roller coaster dynamics, commodities can be a smart part of a diversified portfolio. They tend to have a lower correlation with traditional assets like stocks and bonds, which means they might help buffer your portfolio during certain market conditions. Commodities can also act as an inflation hedge. Gold, for instance, has a storied reputation for holding its value when currencies start looking about as stable as a Jenga tower during an earthquake. Some people view commodities as a way to protect themselves against financial turmoil. If everything else crashes, at least you can cling to your physical gold bar like a security blanket. Just don't try using it to pay for your grocery bill, unless your supermarket happens to be run by very interesting individuals. Of course, trading commodities is hardly risk-free. Volatility can sometimes make the stock market look like a tranquil pond. One poor harvest can send agricultural commodity prices soaring, only for a bumper crop the following year to bring them crashing down just as fast. Energy markets are famously turbulent, with price charts that could resemble a seismograph during an earthquake. Regulatory changes and geopolitical events can also blindside you faster than a water balloon at a summer picnic. If a government decides to slap tariffs on imports or impose export bans, your carefully laid strategy might evaporate. It's vital to do your homework, and I don't mean just reading the first page of Google search results. Understanding global economics, weather patterns, and political tensions can go a long way. But even then, nobody has a crystal ball. So maybe keep your day job until you're confident you won't be trading your car for bus fare after a few unlucky trades. For a few practical examples, consider gold. You could invest by buying physical gold bars, but then you face storage and insurance costs. Plus, no one wants to lug a gold bar to a dinner party, although it could be a decent conversation starter. ETFs that track gold prices or stocks in gold mining companies might be more convenient. If you're curious about oil, you could trade crude oil futures or buy shares in energy companies, or even get into an ETF that tracks an oil index. For agricultural commodities, you could look at funds that invest in wheat, coffee, or soybeans. Just be prepared for the day your grandmother asks why you keep talking about coffee prices instead of how your love life is going. At the end of it all, commodities are not for everyone. You need a strategy, risk management, and a healthy dose of skepticism about every hot tip you hear from your neighbor's cousin who claims to have inside information about a guaranteed winner. But if you approach the market with realistic expectations, a willingness to learn, and an acceptance of occasional losses, commodities can spice up your portfolio like hot sauce on a taco. They're dynamic, influenced by factors that can be as unpredictable as a cat with a laser pointer, and they often play a crucial role in the global economy. Whether you're in it for hedging, speculation, or just curiosity, it's worth taking the time to understand how these raw materials move the world. For anyone new to this realm, a good way to get started is to read up on commodity-specific news, check out beginner-friendly books or online courses, and practice with virtual trading platforms. Find a reputable broker, keep your position sizes reasonable, and don't gamble your entire retirement fund on a hunch that soybeans will skyrocket tomorrow. Always remember that diversification is key, discipline is your ally, and chasing overnight riches is the quickest way to become internet famous for all the wrong reasons.
If you're confident and informed, commodities can be an exciting, if occasionally nerve-wracking, part of your investment journey.
Thank you for watching. If you liked the video, don't forget to give a like and subscribe to support us. If you are interested in our premium content, please also visit our Patreon. You can find the link in the description. Thank you and take care of yourself and your finances.